Systemic financial repression, gold accumulation, and pension vulnerability. 1. Introduction and thesis. USS claims that the present policy mix intentionally suppresses interest rates, inflates asset prices through credit expansion, and shifts risks onto households, with special concern for pensions and small businesses. Footnote. You frame the inquiry around whether policy design redistributes purchasing power from savers to the public and financial sectors. 2. Mechanism of suppressed rates. You evaluate how artificially low policy rates and yield management can create an illusion of stability while eroding returns on safe instruments, thereby incentivizing leverage and speculative risk-taking across the economy. Footnote. You identify negative real yields as the quiet tax that finances the appearance of prosperity. 3. Impact on savers and pensions. You analyze how prolonged repression depresses discount rates and income yields, diminishing compounded gains for retirement plans and individual savers and leaving funding gaps masked by temporarily elevated asset valuations. Footnote. You connect low yields to trillions in foregone compounding that would otherwise accrue to long-horizon savers. 4. Debt expansion and asset inflation. You consider how cheap credit spurs borrowing that lifts equities and real estate while building a fragile debt superstructure whose servicing needs outpace underlying cash flows when rates or inflation dynamics shift. Footnote. You treat credit-fueled price gains as unstable whenever they outrun real productivity growth. 5. Post-crisis policy dependencies. You review the post-crisis pattern in which balance sheet facilities and large-scale purchases prop up duration-sensitive markets, creating a path dependency that is costly to exit without renewed volatility. Footnote. You note that emergency tools, once normalized, embed expectations that are hard to unwind. 6. Gold accumulation as signal. You examine the acceleration of official sector gold purchases and similar behavior by large private actors as a hedge against fiat dilution and interest rate repression, interpreting this as a bet against policy sustainability. Footnote. You read rising official gold reserves as a revealed preference for scarce collateral over paper claims. 7. Covert yield suppression channels. You scrutinize indications that authorities can lower term yields without formal announcements through balance sheet reinvestment choices and liquidity facilities, producing mortgage rate declines that obscure the true stance. Footnote. You distinguish headline policy rates from shadow tools that transmit into term structures. 8. Labor, inflation, and forward guidance. You interpret softening labor conditions combined with moderating inflation as the backdrop for prospective rate cuts, while acknowledging uncertainty around timing and size that complicates household and firm planning. Footnote. You plan for path-dependent adjustments rather than precise point predictions. 9. Geopolitics and systemic stress. You incorporate conflict risk and trade frictions as amplifiers of funding stress, recognizing that shocks can accelerate capital flight, tighten collateral chains, and expose insolvencies that were masked by liquidity. Footnote. You treat geopolitical escalation as a catalyst that can turn illiquidity into insolvency. 10. Failure modes and transition risk. You evaluate scenarios that include debt market crackups, bank runs, phased closures, and a shift toward a redesigned monetary regime, with households most exposed where assets are inflated and liabilities float. Footnote. You focus on mismatch risk between nominal claims and real cash flows during regime change. 11. Individual risk management. You diversify across custodians and jurisdictions, hold a prudent share of tangible scarce assets such as allocated metal, secure self-custody for permissionless digital assets, and avoid all cash offshore holdings that trigger reporting. Footnote. You pair portability with compliance so optionality increases without legal exposure. 12. Strategic partial participation. You keep one foot inside regulated markets to exploit dislocations that repression produces while avoiding conspicuous flight that can invite scrutiny without adding safety, and you document everything for audit resilience. Footnote. You maintain access to opportunity while preserving defensible transparency. 13. Conclusion and next steps. You prepare before constraints tighten by setting custody, terming out fixed rate obligations you would keep, calibrating real asset hedges, and building contingency liquidity, since the cost of these moves rises as policy hardens. Footnote. You act early because repression taxes inertia and rewards advanced preparation.